the concept of time value for money applies to all kinds of investment and asset classes. And at a high level, you can think of two big buckets of assets: traditional investments and alternative investments. In CFA language, this is usually long, liquid, and transparent structure, whereas alternative investments, right, are broader, more heterogeneous, and what makes them alternative is rather the liquidity and complexity. So you see, I highlighted three types of alternative investments. The first one is commodity. The distinction that is usually made in the curriculum is between hard commodities and soft commodities. And to distinguish the two, the mental trick is, is the commodity alive in some sense? So cattle, lumber, soybeans, all those crops have a life in it, and therefore it would be considered as soft commodity, whereas metals, oil would not, and it's a hard commodity. For real assets, the distinction is between brownfield and greenfield. And green, it's simply that the project has not been done before. It's a new project, it's a new investment, whereas brownfield is something that already exists, it's already part of the operation. So usually, most of the time, brownfield is less risky than greenfield. And finally, the most important distinction, or at least the one that is the most discussed, is between hedge funds and private equity. So note that, by the way, VC, that venture capital, would be part of the private equity fund bucket. So hedge funds are pooled investment vehicle, and they trade usually public securities and derivatives. They have many form of strategies like long short, using leverage, global macro. So long short means that they do also short the market. Global macro is an approach, event driven is another approach. So different form of strategy. And private equity, on the other hand, they invest mostly or primarily in private companies, but they can also invest in public companies, taking them private, sometimes with mechanism, or often with mechanism like LBOs, leverage buyout. And finally, the venture capital is more for early stage, high growth company. So between the two, the fee structure differ as well. Hedge funds, they charge a management fee based on AUM, asset under management. And the performance fee is on profit, and we'll get into that in the next slide. Private equity, they also charge management fee and some form of performance fee, but the management fee is on committed capital. So even if the money has not been drawn into the fund, the fee is already charged. Another distinction between the two is that there is clawback, sometimes clawback provision with private equity. And clawback is basically if the performance is not as good as anticipated, the LPs, the limited partner investor, can get part of the performance fee back from the GP, the general partner.